Okay, just now we look into the financial assets. Now we want to look into financial liabilities and as well as the convertible. So please remember, financial liabilities is when we issue bonds or we issue debentures or loan stock for the purpose of funding the business activity. So at the beginning, when we issue the debentures, we have to record at fair value less transaction cost. That can also be called as net proceed. For example, if you sell debentures with par value of 1 million ringgit and you have to incur a transaction cost of 200,000 ringgit, so the net proceed would be 980,000. So let me just write down for you. So let's say you issue 1 million worth of bond. So let's say this is the par value of the bond that you issued, and then you have to incur 200,000 uh, 200,000 transaction cost. So meaning that the net proceed is 980,000. So in other words, net proceed is the amount of money that you receive after you issue the bond. Alright, so for financial liabilities, how do we recognize it? How do we measure? So there are two different approach. We can use the FVTPL as well as the amortized cost. But normally financial asset will use the amortized cost. But I will not be discussing further on the financial liability part because it is more challenging. Okay, so I'm not trying to confuse you, so trying to make it simple as possible. So if you want to look into this further, so maybe if you want to pursue your professional study after this, so you will look into this in more detail. So basically we just want to introduce you about financial instrument. That's it. Okay, so let's continue with convertibles. So this is another important aspect in financial instrument. So what is a convertible? So you have to understand the definition first. Like I have mentioned in the very first slide, convertibles is quite unique whereby it has the characteristic of both equity and liability. Okay, so why does it have both characteristic of liability and equity? It is because convertibles, loan or bond, are able to be converted into ordinary shares. Okay, for example, like financial liability. Let's us compare financial liability and a convertible. So financial liability, let's say you issue a bond, okay, a loan stock, and then it is for the period of 10 years. So after 10 years, you would have to repay back the bondholder, the principal amount as well as the interest. But however, for the convertibles, let's say you issue 10 years convertible bond. So 10 years convertible bond, meaning that after the period of 10 years, you do not pay them cash, but you give them ordinary shares. You issue them ordinary shares as a compensation for them. Okay, you do not pay cash at the end of the maturity of the bond, but you issue them ordinary shares. So that's why a convertible have the characteristic of both debt and also equity. So to to recognize convertible, we have to use the method what we call as split equity accounting. So meaning that under this split equity accounting, the key thing that you have to understand, okay, split equity accounting, to calculate the amount of convertibles that we should recognize when we issue the liability is by having this kind of thing. Okay, so proceed is the amount of money that you receive after you issue the convertible bond. So this proceed will consist of the debt component as well as the equity component. So these two made up the proceed that we receive from issuing the convertible bond. So how do we measure the debt component as well as the equity component? So to measure the debt component, that's why you have to find the present value of all future interest as well as the principal amount that you would have to pay at the end of the maturity date, if you assuming that you will not convert the debt into ordinary shares. And the equity part, how do we calculate the equity part? It is based on the balancing figure. So meaning that you take the proceed minus with the debt, and then you know how much is the equity value. Alright, so let's look at into one example. Okay, this is the example number 2, the last example for this topic. Alright, so let's say an entity issue a 6% convertible bond with a nominal value of £100,000 at par. So let us label what are these numbers about. So this 6% is the coupon rate or the interest rate. So this entity will be paying interest of 6% for this convertible bond. And this is the issue price, how much that the firm is getting after they issue this bond. Proceeds. This is the proceed, the amount that they receive. And at the end of this, at the end of the maturity period of the convertible bond, we can convert this bond into ordinary shares, and the maturity period is within 5 years. So let's say if this is not a convertible bond, so the interest rate, the normal interest rate would be 8%. So meaning that if you did this 100,000 ringgit and you want to borrow from the bank, so you might be charged 8% of market rate. So based on this example, we are required to show the double entry for this convertible bond at issue. So always remember, we need to find the value of the debt component as well as the equity component. We already have the proceed. This is debt, DE. Okay, so this is the proceed. The proceed that we are getting is £100,000. Okay, so the next step is for us to calculate how much is the value of the stock. How to find the value of the stock, of the debt, sorry. The value of the debt, it is the present value of interest plus principal that we have to pay at the end of the maturity period. So let's look at the solution. How do we solve this problem? Alright, so again, your net proceed is 100,000. Okay, so this one, for the debt component, we have to find the present value. So the 8% that we are given here is actually your discount rate. Okay, so to find the present value, you need to use the present value table. But no worries, you will be given the present value table during your final exam. You can refer to the present value table to calculate the present value of the debt. Okay, so just remember that the 8% given, the market rate, is actually the discount rate that you have to use to find the present value of the debt. Okay, so every year we will be paying interest of 6%. So in this table here, this green table, so we are calculating the present value of the debt. So we know that this debt is for 5 years. So every year we will be paying interest, and the interest rate is 6%. So after the end of the 5 years, so the present value of interest that we will be paying is 23,958. So at the end of the 5th year, we also have to pay for the principal amount. So we have to convert this 100,000 into the present value. So we know that the debt component is 92,058 pounds. Okay, So we have identified what is the value of the debt, value of the present value of the debt component. So your next step is for you to find the balancing figure. 100,000 minus 92058. So the value of your equity would be 7942. Alright, the next thing is to record this transaction, to post this transaction. So debit cash 100,000. So this is the proceed that you receive by issuing this convertible bond. And then you have to credit the liability, which is the debt component, 92,058. And you have to credit the equity, 7942. Okay, so this is how you post transaction related to convertible bond. Alright, now it's your turn, your part. So this is actually your seminar question. You have this question in your handbook. It's just that for this question in your handbook, there are four requirements, but I only want 1, 2, 3. So please refer to this question, Wigan PLC. Question, there are 3 scenarios. Scenario 1, 2, 3. You are required to discuss the accounting treatment for this Wigan PLC. So please submit by today before 11 p.m. Please submit via Turning In. I have created a link in Turning In. Please submit in that. Okay. If you have any trouble to submit in Turning In, you can always email me. So this is my email address. So while doing this exercise, if you have any questions, please ask me so that I will be able to assist you. Alright, so for homework, for your weekend homework, okay, later on, by tomorrow, I will post another video which is on IFRS 5 revenue recognition. So that's it for today. Thank you, class.